Macquarie today manages in excess of $500 billion of assets under management. And those assets under management are quite sensitive to lower interest rates. Those assets are things like infrastructure, things like real estate, things like fixed interest. And generally speaking, those asset classes, the valuations benefit from when interest rates fall. Now, Macquarie, over its journey, has been quite prudent in how they've actually structured up these funds. And generally speaking, a lot of these funds have performance fees as well. So when interest rates fall, it gives Macquarie a chance to potentially crystallise a performance fee when the funds actually hit maturity or are crystallised. So we think that that's an embedded profit stream for Macquarie that's quite beneficial. We also think about Macquarie from a global perspective. Now, Macquarie is now a world-class investment bank. If you cut back to when Macquarie actually listed on the Australian Stock Exchange, which was in 1996, the business had $5 billion of assets. You cut forward to today, and there's $200 billion of assets. It's grown exponentially. And we think that the business that Macquarie has now is actually a world-class business. So we can actually peg Macquarie against its global peers. And when we do that, what we find is that Macquarie's got a return on equity that's around 17%. When we look at its peers, and these are global, well-established peers, the average is more like 7. So Macquarie's ROE is 2.5 times higher than its global peers, and these are peers that have been around for a long, long time. All investment banks globally have had to deal with regulatory change, and they've all had to de-gear their balance sheets, and Macquarie's no different to that. They've had to halve their gearing over the journey. But despite that, they can still generate that return on equity. But what's probably more interesting is that the PE that Macquarie trades on today, which is around 14 times forward earnings, is only 1.5 times higher than the global peers, who are trading on around 9 to 10 times. So we think that Macquarie is actually offering reasonable value versus its peers because its business model, we think, is better positioned. It's not as capital hungry as the global peers, which means that Macquarie can give more of its profits back to shareholders. So again, if we go back to 1996 when Macquarie listed, its dividends have grown, dividends per share have grown by 10% per annum for nearly 25 years. And when we look forward, we still think there's growth in the tank for Macquarie. We still think they've got the capacity to generate growth. But market forecasts are more thinking that Macquarie's hit saturation and it can't grow its dividends by more than 5%. That's the general expectation. Now, Macquarie's got a great habit of under-promising and over-delivering. So we think there's a really good chance that Macquarie continues to surprise the market on the upside. So for us, we're happy to hold Macquarie. We're conscious it's done really well over the journey. But when we look at the dividend yield, which is pushing 5%, when we look at the business model where we think they're best practice in a lot of their assets that they carry, we're really happy to hold it at these sorts of levels. And we can see a situation where Macquarie could push to an ROE of around 20%. That would be a great outcome, and that would deserve a 3.5 time book value. So we can see a pathway to Macquarie pushing through 150 in the not too distant future. So we're happy holders.